So good afternoon, everybody. Thank you for coming to this presentation. My name is Oka. I'm a financial advisor with Greatway Financial. And this is just a continuation of the financial series we started like 3 weeks ago. And I want to also apologize that I was supposed to have this session last week, Monday, but I was not feeling too well. That's why I had to push it to today. So thank you, and I hope we all get value for our time. And today we're going to be talking about the topic life insurance. And from the last episode of our financial series, where we talked about the building a financial house, we established that life insurance or a life insurance policy is the foundation of our financial house. And that is because of the benefits that the life insurance policy can provide. We all know that the structures in our financial house are put in place and maintained by income or cash or money, whatever we want to call it, right? And a life insurance policy makes sure that those policies and those structures that we've built over time and in our lifetime remains in place, even if we are no longer there to financially fund it, because the life insurance policy will leave a lump sum to our beneficiaries, which they can use to maintain the structures in our financial house. And that is why the life insurance policy is the foundation and bedrock of the financial house. Now, what is a life insurance policy? In the simplest of terms, a life insurance policy is a contract between the policyholder and an insurance company. The insurance company promises or guarantees that a lump sum is paid out to a named beneficiary in the event that the life insured passes away. And that is what a life insurance policy is in the simplest of terms. But over the years, life insurance policies or some type of life insurance policies have evolved that they provide other benefits apart from just a death benefit. And that is, we're going to be looking into that today. Now, what are the benefits of a life insurance policy, or why should we have a life insurance policy? One of the first benefits of having a life insurance policy is that, well, when we pass away, our beneficiary gets a lump sum payment, and the payouts that comes from this life insurance policy are usually tax-free. So no matter the amount of money that gets paid out to our beneficiaries at the end of the day, is going to go out to them tax-free, be it 500,000, 1 million, 2 million, whatever the coverage is on your life insurance policy. The second benefit of having a life insurance policy is that, like I mentioned in the last slide, some life insurance policies have evolved over time to provide other benefits apart from just the death benefit, right? So some life insurance policy can actually provide income to supplement our retirement planning. So in retirement, we can actually get out money from our life insurance policy to live on, even though a life insurance policy, like I mentioned, is the primary work of what the life insurance policy is supposed to do is to provide a lump sum payment to our beneficiaries. But some life insurance policies can actually provide what we call living benefits. That means you, the owner of the plan, can actually benefit from your life insurance policy. Now we're going to go to the next benefit, which is called the rider or riders, because some life insurance policy have what we call riders that are attached to them, meaning extra benefits attached to them that can give us some other payouts. So for example, we have riders for critical illness attached to a life insurance policy. So that means if you have a life insurance policy and you have a rider of critical illness attached to it, if you're diagnosed with a critical illness within your lifetime, a lump sum payment is paid to you. The riders for disability, if you develop a disability within your lifetime, your insurance policy pays you out a lump sum. So we have riders that can be added to a life insurance policy. Inheritance. A lot of people want to leave an inheritance to the next generation, either their children, their grandchildren, or whoever they want to leave an inheritance to. And the life insurance policy is a way to do that, because remember I mentioned to you that a life insurance policy pays out a lump sum, and it is usually paid out tax-free. So this is another way to plan an inheritance for your loved ones or beneficiaries, where you can leave a huge sum of money for them tax-free. And then people also get life insurance policy to pay probate fees. And what are probate fees? In Canada, the biggest tax you're going to pay, yes, a lot of people complain that taxes in Canada are quite high, but the biggest tax you're going to pay in Canada will be after your demise, after your death, because all your investments in properties, in cash, will be summed up, and there's a calculation that will be put in place where the money or whatever they feel the worth of that, of your estate, is called an estate, everything you own in your lifetime, whatever the worth is going to be taxed at that point in time. And whoever is the beneficiary or the inheritor of that estate has to pay that tax. And for a lot of us that want to leave an inheritance, like maybe want to leave real estate investments to our children, or we have a business that we want to leave to our children, we have to put into account that at death, we're going to have to pay probate fees. And if we're not careful, all our hard work over time might go down the drain, because if our children or the inheritor of that estate doesn't have enough money to pay the probate fees, they might have to sell off some or all of the properties in that estate just to pay the probate fees. So taking a life insurance policy to cover your probate fees is also very important and also very beneficial. Then one of the final benefits of having a life insurance policy is to pay for the final expense. And what do I mean by final expense? Final expense is everything that has to do with your burial when you die. In Canada, funeral expense is between 10 to 20,000, an average of 10 to 20,000. That is how much it costs to perform, to lay a loved one to rest in Canada. And it is very stressful on the beneficiaries, on the loved ones that are left to start to struggle to get that kind of amount of money in place just to make their loved ones to rest. So a life insurance policy can actually take that burden off our loved ones to make sure that when they are mourning, they are not also stressing about finances just to lay us to rest. Because we find out in our community that a lot of times people pass away and their loved ones have to go through GoFundMe just to lay them to rest. And that is not what we want to put our loved ones through. So taking out a life insurance policy will protect them in that regard. Now, we're going to talk about the best time to take out a life insurance policy. If you ask me, when is the best time to take out a life insurance policy, I will tell you, you should have taken out a life insurance policy yesterday. But since we don't have a time machine to go back in time, I'll tell you that the best time to take a life insurance policy is right now. And I'm going to give you 2 reasons why I say that. Because the first one is that a life insurance policy gets more expensive the older you get. So we have 2 females, for example. One is 30 years old, the other one is 35 years old. And both of them want a coverage of, let's say, 500,000. The female that is 35-year-old will be paying a lot more than the female that is 30 years old because she's 5 years older. So if we keep procrastinating and pushing getting a life insurance policy down the line, we'll find out that it gets more expensive. And a lot of times we get to a point where we might not be able to afford the amount or the adequate coverage we need because it has gotten so much more expensive because we've wasted a lot of time. Now, the second reason why you should get your life insurance policy as soon as possible is that when you put in an application for a life insurance, for example, right, there is no guarantee that you'll get approved. That is because the life insurance application goes through what is called underwriting. Underwriting is just the fancy name of an investigation that the life insurance company is going to carry out on an application to make sure that that individual is insurable or it's not a great risk that they are carrying on. And during the application process, they're going to be asking you questions about your health status and about your lifestyle. And that will inform them on whether or not you're going to be insurable. I've had a few clients where They know the importance of having a life insurance policy. They want a life insurance policy. We put in an application for them, and unfortunately, because of their health status, they were not approved. So the younger we are, the more the likelihood that we are healthier. So we should try and get our life insurance policy put in place so that we don't get to a point where we are uninsurable, because nobody knows what will happen in 1 week, in 2 weeks, in 1 year's time, right? And the older we get, there's a higher tendency that old age related illnesses might creep in, and we might find ourselves in a position where we want to get a life insurance policy, but because of our health status, we are not insurable. Now, who should get a life insurance policy? In earlier times, where the type of life insurance policy that was available was just one that could get you a death benefit, it would be only people that have dependents on them. But like I earlier mentioned, life insurance has evolved over time to provide benefits that are apart from just the death benefits, living benefits, right? So anybody can qualify for a life insurance policy can actually benefit a lot from getting a life insurance policy. So everybody can get a life insurance policy. Now we're going to go into the types of life insurance policy. There are two major types of life insurance policy. We have the temporary life insurance policy, which is still the simple life insurance policy where the only benefit you get out of it is a death benefit when you pass away, and the death benefit is paid out to your loved ones. The second group of type of life insurance we have is a permanent life insurance coverage. And this type of life insurance coverage has both the death benefit, that means when you pass away, a lump sum is paid to your beneficiary, and it also offers what we call the living benefit. And for the permanent life insurance policy, why it can offer a living benefit is that the premium that you pay for your life insurance policy is split into two. So a part of that premium goes to pay for the cost of pure insurance, that's the death benefit, while the other part goes to pay or is invested for the owner, that's the owner of the policy, right? Is invested into either stocks, bonds, equities, so that it grows cash value in that policy to provide living benefits for the owner of that policy. And the two major types of permanent life insurance policy that we have are the whole life and the universal life. Now let's talk about temporary insurance. The temporary insurance is popularly known as term insurance. And like the name implies, it is a temporary insurance. So there is a particular time that you are covered for. For example, you can take a term 10. That means for 10 years, if you take a $500,000 coverage, within that 10 years, you are covered for $500,000. And if you pass away within that period, that 10 years period, your beneficiary gets that $500,000 payout to them tax-free. So you can get a term 10, term 20, term 30, depending on which of the companies you're going with. Now, the advantages of having, or the advantages of particular type of insurance company policy is that it is cheap. It is very cheap, and it is the cheapest type of life insurance that you can get. Then the other benefit is that it is very simple to understand, because it's just a simple life insurance policy where you pay a particular premium and the insurance company guarantees that they will pay to your loved ones a certain amount of money if you pass away, and that is it. There's no other complicated thing going on there. That is just it. Then the disadvantages of this type of insurance policy is that it is temporary. So you take a term 10 policy, for example, after 10 years, you are no longer covered. You have to renew. Then there's an exponential increase in price with age. Like I mentioned in the previous slides, the older you get, the more expensive a life insurance policy gets. So though a term insurance policy starts out really cheap, by the time you're getting into your 60s and 70s, where you might need insurance in case you need insurance at that particular time. It gets so expensive that a lot of people cannot even afford it, even though it's term. And a lot of companies do not even give term insurance at, I think, starting from 80 or thereabout. I'm not very sure about that, but some companies do not provide a temporary life insurance at a particular age anymore. So if you have just a term insurance policy over your lifetime, you might get to a particular point where you would not have any insurance coverage over your life anymore. Then there is no cash value attached to this particular type of insurance. So when your term comes to an end, that is the end of it. You don't have anything to show for all the premiums you've been paying over the years. And then another thing comes down to the claims, right? When there's a statistic that says that only 1% of term life insurance policy ended in a death claim. Well, it's good in a way because it shows that the people that took out the life insurance policy did not die within the term of their life insurance policy. But that goes to show that a lot will push for the term insurance policy because they know that there's a 99% chance that they don't have to pay on that death claim. Then there's uncertainty. Your term policy will stop providing coverage at a particular time when the term ends, right? Because it's a temporary insurance. And when that term comes to an end, who knows what will happen in the next 20 years? You might feel that, okay, my kids will be all grown up and I would not need an insurance coverage, but nobody knows how or what will happen in the next 20 years. The 20 years might roll by and you will find out that you actually need insurance. But at that point, you're 20 years older. That means your insurance to get a new policy would be much, much more expensive. And you might not even be healthy enough to get another insurance policy set up for you at that particular point in time. So it leaves us uncertain about whether or not we'll be covered at a particular time. Now let's go to the permanent types of coverage. The first one is the whole life coverage. The whole life coverage is a permanent coverage. And the whole life is like the oldest type of permanent coverage we have out there. And this is why it's a bit rigid. And okay, let's just go through the advantages and disadvantages and you understand why I say it's a bit rigid. The advantages of having a whole life coverage is that it is a permanent coverage. As long as you pay your premium, you're covered for the rest of your life. So even if you live to 150, you're covered for the rest of your life. The whole life insurance builds cash value and the growth of the cash value is guaranteed. So remember when I was telling you about the permanent life insurance policy, where your premium is split, the part goes into paying for the cost of insurance, that's the death benefit, and the other part goes into an investment, and that's where you now start talking about cash value. One of the advantages of life is that cash value, the growth on that cash value is guaranteed. The company will tell you a particular percentage in which your cash value will be growing over the years. So this is an advantage, but it can also be a disadvantage if the market changes and the market is doing far, far above, because though there's a guarantee, it is also a cap. And usually the guarantee that is given is not usually so much. It's between 3 and 6%, depending on the company you're going to be getting your life insurance policy from. Now, the portion of the tax-free investment gain. So the portion of the life insurance policy that will be invested and growing is going to be growing tax-free. So at no point are you going to get any tax slips from the government stating that, okay, you have gained so and so amount in your investment, so you pay taxes on it. So it grows tax-free. And for the whole life policy, if you need to cancel your whole life policy, any cash value that you already have grown in that account will be returned to you. So at the end of the day, at least you have something to show for all the premiums you pay over time. Now for the disadvantage, the whole life policy is very expensive. It's the most expensive life insurance policy you can get among the three that we are talking about today. It is not very transparent. And what I mean by it not being transparent is that you cannot differentiate, or the policy doesn't show you exactly how much you're paying for your life insurance coverage and how much is being invested. The policy doesn't show you where your money is being invested or how your money is being invested. So you cannot just take up your whole life policy and say, okay, $100 is the cost of insurance, and the extra $200 is being invested in an S&P 500, in the NASDAQ 100. You can't do that with the whole life. So only the insurance company knows exactly how they split your money and how they invest your money. It is not very flexible. And when I say it's not very flexible, it means that whatever you sign as a contract in your whole life policy, that is what you get. You cannot increase your premium. You cannot decrease your premium, even if you are cash strapped. You cannot increase or decrease your coverage. Now, depending on the market, on what the market is doing, the interest you earn on your cash value might be low. Like I mentioned, it's between 3 to 6%, right? But there are sometimes the market does, depending on which of the equities or which of where you invest your money. But if you invest your money and that market, that particular equity or that particular portfolio is doing 20, 26, 30% for that year, then the insurance company has guaranteed that your money is 6%. You're going to have to take the loss in that sense, because it is guaranteed that your money is 6%, but that is the cap. You cannot take advantage of when the market is doing very well, which is most of the time. Most of the time, the market is actually doing very well. But it's also of an advantage, because when the market is not doing well, you are not going to be affected. So the next type of permanent life insurance policy we have is the universal life insurance policy. And the advantages of this particular type of policy is that, one, it is permanent. So for the rest of your life, you have coverage. It is very transparent, because if you take a universal life policy and you look at it, you can tell exactly how much is going to your cost of insurance. You can tell how much is being invested for you. You can tell which of the equities or which stock or which portfolio your investment is growing. And you can actually even dictate where, for people that are very financially savvy and know how to invest, you can actually direct exactly where you want the investment portion of your policy to be invested. So it's very transparent in that regard. It builds cash value because a part of the money is being invested, just like the whole life. Also, it has the investment portion. The gains you're going to be getting on your investment portion is going to be growing tax-free. So you're not going to be receiving any tax slip from the government. It is very flexible. When I say flexible, it means that you can increase your premium. So for example, if you're putting in the original premium was supposed to be $200 per month, and you want to increase it to $300 per month because you want to put in more money in your investment portfolio, you can actually do that. If, for example, you lose your job or your hours are reduced and you cannot afford that same $200 every month, you can actually call up the company or your advisor and tell them, I need to reduce my premium to a certain extent, right? And your premium can be reduced and your policy will still be in place. And you can actually increase or decrease the coverage amount. So if you started up with $500,000, you can decide to reduce it to $400,000 or increase it to $700,000, depending on what your situation is at that point. Then there's the cash value that in this particular type of life insurance policy grows at a variable interest rate. The market, whatever the market is doing, is how your cash value will grow, right? This is an advantage and can also be a disadvantage, because if the market isn't doing so well too, you're going to be affected. And also, when you cancel a universal life policy, any cash value that you have already grown in your policy will be returned to you. So you have something at least to show for all the premiums you've been putting in your policy over the years. And then for the disadvantage, as a permanent life insurance policy, it is expensive when compared to a term policy, but not as expensive as the whole life. So this is the middle ground between the whole life and the temporary insurance policy. Then, because of the variable rates of what happens in the market, your interest, like I mentioned earlier, will be affected if the market is doing very badly at that point. You would also be, your investment portion will also be affected. Now, which is the best life insurance policy to get? For a financial product, there is no one size fits all. You would have to talk with a financial advisor to decide which of the plans fit you at the particular point in your life. Because, for example, for someone that wants a permanent insurance policy, but your finances are really not in a place to take a very expensive or an expensive policy, you can actually go with a temporary life insurance policy. And the good thing with a lot of companies is that they offer temporary insurance coverage that is renewable and convertible. What it means is that if you take out a temporary insurance policy just because, okay, I just need a coverage now because I want to have that peace of mind that my family is protected, my loved ones are protected in case the inevitable happens. But what I really want is to take advantage of all the benefits that a permanent life insurance policy can give. You can actually take a temporary life insurance policy, say a 1010, to get that coverage. And by the time you get on your feet and your finances are okay, you can then convert that temporary life insurance policy into a permanent one. And the advantage of doing that is that at that point, your policy will not be going through underwriting. So irrespective of what your health status is or what your health status is, your policy will be converted into a permanent policy. The only difference is that your premium will increase to match what is supposed to be for a permanent policy. So no one size fits all. You would have to sit and discuss with an advisor to see which of the policies is best for you and which one you want to take advantage of. And like I always say, it's not what you know that matters, it's what you do with what you know. So this is the end of the presentation, and I'll be happy to take any questions that you would want to ask at this point. So you can unmute yourself and ask any question you want.